Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running, and I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great. Well, hello, I'm Chris McAlpin with The Chase, the host of this podcast. And our goal in this show is to educate you, is to encourage you. It's to fortify you to not only deal with these economic times, but to also thrive in them. There's going to be financial ups and downs. And, you know, our world is definitely on a wild ride. And when you throw all of the news cycle in it, it is a roller coaster ride, but man, we are feeling every twist and turn and every up and down. You know, I get in these conversations a lot, and it's really kind of part of it. People want to know, who do we blame? Who do we point fingers at? But I think what's best, with the best response that we can have is, how do we take responsibility and manage what we can manage? And I intentionally don't use the word control in this, because it's times like this that remind us just how much we're not in control. Like, I can't predict the future. I don't control the stock market. I certainly don't control the economy, you know, and it can be very depressing, but there are areas in the economy in your household that you can control. We want to dive into those topics today, because we're seeing on this news cycle again, inflation, rising interest rates, and now recession. Cue the really dark, bad music. I got to tell you, times like these made me think of the old Friends song. And I can hear the tune in my head. I can't remember the exact words, so I had to go look them up. So no one told you life's going to be this way. Your job's a joke, you're broke, your love life's DOA. It's like you're always stuck in second gear when it hasn't been your day, your week, your month, or even your year. Makes me remember sitting back in a college dorm watching those in the 90s. I remember one of the episodes, Joey and Ross, one of them had black leather pants. I had a buddy that had black leather pants. But, you know, he's now in upper management in a medical device company. And thankfully, there were no cameras and phones around in the 90s, or no cell phones anyway. So there are a lot of economic events that we need to talk about these days. Recession is the biggest topic. And I can remember coming out of school and getting into my first grown-up job, having studied the financial world in the 90s. I get hired with automatic data in February of 2000, right at when the market peaked in March of 2000. We're going to go into a double-dip recession. We're headed into a bear market. And I remember asking my dad, Daddy, what do you do? And he kind of chuckled, because he was about my age then. And he said, son, he said, when somebody asks you how's it going, tell them it's going great. Perk your butt off, put a smile on your face. Tomorrow's a new day. And that short piece of advice has always stuck with me, because bad times don't last forever, and things just simply cycle. And so today we're going to talk about recession. I've been asked this question by a number of clients and people, just what is a recession? How does it affect our nation? And most importantly, how can it affect you, and what can you do about it? And so joining me, as he often does, is Clint Sorenson, Chief Investment Officer at Wealth Shield and Lead Investment Strategist at Sound Financial. Hey, man, what's up? How you doing?
Hey, how are you, Chris? Happy to be here again.
I'm good. Hey, man, thank you for taking time away from a little vacation. You know, we do let you go on a vacation every now and then. And
that's right.
I appreciate you taking a few minutes away. I didn't know we scheduled this. I was interrupting your vacation. I apologize.
Not an interruption. I've worked the whole time here, but it's nice to work from the beach for a week. So it's my wife's family reunion. She has tons of family, cousins, and it's just amazing. They've been doing it for 47 years, which is amazing. Yeah.
That is amazing.
Yeah. Great tradition. So
we've got a family. Yeah. Good deal. Yeah. That's awesome.
Great time.
Well, tell them all I said hello. Your lovely wife, your lovely daughter, and I apologize for taking you away. So I've got a stat for you. It's not near as much fun as the beach and on vacation. But here we go. Again, bum, 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 bum. We'll cue the dark music. So the CPI is above 6.5%. And effectively, that's inflation. What you feel, folks, when you go to the gas pump, when you go to the grocery store, is measured by an acronym, Consumer Price Index, CPI. It's above 6.5%. That means prices have risen in the last 12 months that much. It's actually higher. And the U.S. stock market is negative 20% over the last 5 months. Every time that's happened since World War II, Clint, we've gone into a recession. Does it predict a recession this time?
Yeah, so nothing ever predicts a recession. I'll tell you why. Let's always start with the definition of a recession, because this is so misquoted in the media. I mean, I heard it the other day on a major national financial media show. They were quoting that a recession was 2 consecutive quarters of negative GDP. That definition is found absolutely nowhere on the National Bureau of Economic Research's website, the NBER, who actually is responsible for defining a recession. And so let's define it first, and then let's get into what type of stats are out there that have suggested this is likely a difficult economic time. So first and foremost, the NBER, and I'm going to read it from their website, the National Bureau of Economic Research website. And it says the NBER's definition emphasizes that a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. Now, that is a lesson in vagary. I mean,
what's that mean, man? Because that's vague. And we study this, and that's vague.
Yeah, so there's not a whole lot you can say about that definition. So what we've done at Sound, right? I mean, how often do we talk about a recession? It's not often. What we talk about is the economy slowing or growing? Is it accelerating or decelerating? And we find that far more useful in when you're considering what to do, whether from a business standpoint or whether from an investment standpoint or household finance standpoint, right? The way you react to the information shouldn't be based on the name or some government entity deciding something that is only going to be known in hindsight. That is a very dangerous thing, because in order to wait on that vague definition to be fulfilled, you're waiting on an agency to say, hey, we're in a recession. And Chris,
government agencies don't move very fast.
Exactly.
I didn't know that.
Exactly.
Okay. I got to go get my driver's license next week.
Yeah, I've been at the DMV recently. You've experienced
right.
it. But I mean, that just gives us very little to act on. And so we can, when we're concerned, Chris, like in Sound, what we're talking about is how do we make the best investment decisions and financial decisions to be good stewards of wealth. That's the goal. It's not to try to pinpoint a recession. And so what we find useful, and I know this is redundant to things we talk about all the time, Chris, in private, but this is about, are we growing or are we slowing economically? And we talked about this since Q3 of last year, that this quarter was going to be an economic slowdown. And so there's ways to prepare for that.
So is that so just to go back, we'll answer the question in layman's terms. A recession is a slowing economy or a shrinking economy. There's a couple of different variations of slowing. So let's call it GDP has gone negative year over year. Is that a fair enough definition?
Not a sort of a recession, right? Because that definition of a recession is so bizarre. It's, in my opinion, I think the definition, that's a definition of a slowdown, a contraction economically.
Contraction. Okay.
Yeah.
Okay.
Right. So let's define the 4 phases of a business cycle.
Yeah, because as we answer the question, now let's go make it useful, because I think that is where you've said this, and I've quoted you many times on it, and I have found in our experience together this to be tremendously useful. If you get the business cycle right, what?
You get the market cycle right.
You get the market cycle right. So when you're talking about the 4 phases, that's a part of the business cycle, right?
Absolutely. And that helps you understand where you're at in a present environment. And that's how you make decisions. We say, hey, right now, today, we are in an economic slowdown. So what's the playbook?
Go.
And that goes back to your opening comments, which I think were fantastic, about taking responsibility, right? The fact that we're in an economic slowdown or have inflation, we can play the fault game and the blame game all we want, but that is not useful. What's useful is taking responsibility and saying, this is our present day situation. How are we going to respond to that in the way that we best can? And I think that's where, the sound approach differs, in my opinion, is that we are focused on real-time data today. We're not concerned with trying to predict the future or live in the past.
Okay. So answer for me real quick, the four phases of the economy.
Yeah, so the 4 phases of the business cycle, I'm going to define them relative to what's normal. So it's called trend. So trend growth would be what we would normally grow at as an economy. And that's, call it 2 to 3% real GDP. So GDP after we factor in inflation. So that's kind of what we're expecting to grow at or have grown at historically. And so we think of the economy as a normal growth rate being somewhere between 2 to 3% GDP after inflation. Add 2% inflation, which is historically the average, not this year's average, obviously.
942%. Yeah.
Yeah, exactly. But you add that back. And so you're looking at a nominal, which would be a GDP growth that you would kind of feel before we factor in inflation of around, call it 5%, is what we would expect to be normal in an environment. So we'll call that trend growth. The reason I define that is because there's 2 phases of the business cycle above trend and 2 phases of the business cycle below what's normal. And so what happens is when you go into a recession, which we'll call a contraction here, because that's the only thing we can measure is whether we're contracting or not. And there's been times where we've had a contraction in the economy, i.e. 2016, Chris, and the National Bureau of Economic Research did not declare that a recession. So that doesn't mean that will be looked at as recession historically, but that's the way we measure it. So
sure.
When you're in an economic contraction, you're below trend and your growth is decelerating. So that's an environment where not only are you below normal from a growth perspective, but you're also continuing to get worse. So that's what an economic contraction, and that's why it feels so bad. It feels like there's no end to the pain and suffering. And that's because things keep going down, right? You have these negative reactions by stock prices, which continue to exacerbate the problem. So when you see these type of developments, it's typically a contraction. So contractions below trend growth, that gets worse. A recovery is below trend growth that's getting better. So that's a recovery. That's like one of the best times to start investing. Things are depressed, but they're improving. The next phase is when you get above trend. And that's when you're improving, but now you're above normal. So you're really starting to heat up. And that's what we call an expansion. And then the last phase is what we call a slowdown. And that's when you're above trend, but you're decelerating. So you're starting to slow down, right? You're not improving as much or as fast. And so those are the 4 phases of the business cycle. You have your recovery, which is kind of the first coming out of a contraction. You have your expansion, you have your slowdown, then you have your contraction.
Yeah. So all year long, we've really been talking about a slowdown. Is the data telling you that we're in a contraction?
Yeah, we're in a contraction. We entered a contraction a couple of months ago when we put that out in our leading economic indicators, Chris. Mm-hmm. When you remember the indicators we launched, I think it was maybe May into April.
Wealth Shield leading economic indicators.
Yeah, the Wealth Shield leading economic indicators. When we launched that,
for all of our friend nerds out there.
Yeah, that's right. When we launched that was that had contracted to negative 6.95% year over year. That's a contraction in our book. And we also had the ECRI, the Economic Cycle Research Institute's leading economic index on a year over year basis, moved negative 4 or 5%. So you've got confirmation among leading economic indexes that we are in fact slowing or contracting as an economy. And so it wouldn't surprise me to see the National Bureau of Economic Research declare this a recession. Problem is they'll probably do that when we're on our way out.
Mm-hmm. And so if we get the business cycle right, we get the market cycle. So let's go to the markets a minute. What's the playbook for a contraction?
Yeah, let's talk about the playbook of all 4 phases, because I think that'll help us in terms of how we navigated this, right? So when you're in an expansion, and I'm going to talk about it just purely in the phase of growth accelerating to keep it simple. So let's just think when the 2 phases were growth accelerating, recoveries and expansions, what do you want to be in? The 2 phases were growth decelerating, what do you want to be in? So that's the way we look at it. When growth's accelerating, you want to play offense. The offense is on the field. So what does that mean? Well, that means I want to have growth, right? I want to have equities. I want to have small cap equities because I want to try to capture that small premium. I want momentum, meaning I want things that are really running, either have high sales growth or they have high, market price growth. But I want momentum. I want to stay with the winners, the strong stuff. That's what you bet on. And really, even the trash can rally, meaning the companies that aren't that profitable, losing money. We saw this.
We see this in recoveries. We see this in expansions, both recovery and expansion. Yeah, this expansions where you get kind of the irrational exuberance, right? Where you start getting the meme stocks, the bankrupt stocks. We see them go up a stupid percentage. Yeah. And it kind of becomes in, you start getting a little bit of bait in there, a little bear bait, and that starts pulling people in. So you get those in both recovery and expansion.
Recovery and expansion. Recovery is a little more orderly, where typically you get big runs in the distressed stuff, the stuff that survived, right? So let's say you go through a phase, and in every bear market, there's an area that gets hit, right? There's some sort of sector that runs into trouble. And every recession we've had. And what you find is that the things that really run up early in a recovery are those things that just were able to make it through that contraction without restructuring.
It's kind of those. The thought behind that is, correct me if I'm wrong, but it's that only the strong survive a contraction. That if you're left standing, especially if your sector gets massacred, think real estate and financials 08 and 09, think tech in 2000, 2002. If you were left standing after that, the kind of common thought is that you must be a pretty decent company and you're an easy buy. Is that a fair?
Yeah. And then value managers, right? So just institutional money managers that have a value orientation, they're flocking there because they're picking amongst the bones. So because there's value. And a lot of times in contractions, as you've seen this year in tech, you've had really good companies thrown out with the bad. And I think that is just a common theme we see.
Yeah. So what do you do in a contraction and a slowdown? Because
that's key. So you want to take risk on one side. Now you want to play defense when you start to slow down. And that's really the regime change that's the most important to grasp from a protection of wealth perspective, is the move from expansion to slowdown. So a lot of our work, Chris, is really focused on that turn. We want to make sure that we are as early to that peak as absolutely possible, because the reason why is the slowdown can really accelerate to the downside, like this environment we're in today, if you have external factors that all of a sudden happen. And case in point, we had a slowdown in 2018 prior to COVID. COVID was that catalyst that just kind of tossed us into a really deep recession. If you look at this environment, we were already set to slow, and the Fed was going to tighten into that slowdown. And then you have geopolitical events that create that fuel to that economic fire. So it's really important to get that right. And so what I always say is, on the slowdown, you want to do really two things. You want to shift up quality in your portfolio. Now, what does that mean? One of the ways I can define that theme is profits over promises. So a lot of these growth companies, these meme companies, not saying they're bad companies, but what I am saying is that their prices were bid up on hopes of the future, of hopes that they would grow to a certain revenue size or profitability in the future. Whereas when you get into an environment where the economic tide's moving back out, right, you've got to look at who has profits, who can actually withstand any kind of economic slowdown. And so that is one of the best things you can do, is shift up quality. The second thing, and they're not always the same, is
I'm laughing because people find that so hard, don't they? I fully understand this emotionally, but you have your friends bragging at the golf course that they bought such and such stock and it is just going through the roof. And then here it is, yours and my job to look at a client or a friend of ours and go, yeah, but that company is a dog and that stock is just skyrocketing, and that company is a dog, but that stock is skyrocketing. Yeah, but that company is a dog. And it makes, I get their point of view. I had a friend a few years ago. He's like, don't put me in bonds, Chris. Bonds suck. I want stocks. That's where the money's made. And this is about I said, what if I showed you a chart that over the last 20 years, bonds had outperformed. This was in 2020, a couple of years ago.
Hey, it's still true today, right? 20-year return.
Same as today, exactly. And it was no way. It was like, yeah. You just don't get to brag about bonds. That's the thing, But I interrupted
cocktail
you.
party phenomenon's a real thing.
It's a real thing. It is very much a real thing. That's exactly right. It's the cocktail party phenomenon. What are you going to talk about? I know for our Baptist friends out there, we don't go to cocktail parties, but we do. We put it in coffee mugs or something like that. But I shouldn't be. I'm better smart after that. I'm sorry. No, I'm not. But so profits over promises.
Yep, profits over promises,
and in the contraction and the slowdown, and
so that shifts up your quality. Going to profits also helps do a couple things. Number one, dialing down volatility, which is the second thing you want. So shift up quality, and then second, lower volatility in the portfolio. They do help in the equity bucket together, but you have to go further than that. That's why we start recommending alternative buckets, looking at trend following, right? Just adding simple strategies that can alter the profile of an overall portfolio. We don't want to just be long only buy and hold when you get into an economic regime shift, right? I mean, buy and hold works when you are in a growth environment, in an expansion, and one where growth's accelerating. Buy and hold doesn't work when you get into a pretty massive or nasty slowdown in an economic contraction. So we want to definitely lower risk in the portfolio. Lower volatility is a way that, our industry looks at it. I would say lower that downside volatility. I want all the upside volatility I can get.
Give me all the upsides you want, man.
Yeah, I just don't want.
So we're saying that we can make zero losses in all the games?
No, but you cut your losses short, right? So so what you have to do is you have to that doesn't exist, right? But there is a way that you can cut off what I call the left tail. So if you think about the stock market, we have more frequent than we would expect, but we have fairly infrequent major losses, as if you look at the overall index. Now, if you look at individual stocks, you have call it 1 in 5 lose about 75% of their value. So about 20% of the companies over time lose about that much of their value. So it is they're there, and it's
possible. That's a good way to describe that. Let's stay on that, because when you say cut off the left tail, I think this is important, because when I talk about this a lot, I say our number one rule is to avoid large losses. And I think people hear that means that we're going to avoid all losses. It's not what that means. We will not avoid all losses, but you're referencing a study, was it Lombard Asset Management that did the study of all the stocks in the Russell 3000, maybe over about a 15-year period of time.
Yeah, it was Lombard Asset Management. Yep.
Lombard Asset Management. So about 1 in 5, let's round some numbers because neither one of us are looking at this study right now, but it's about 1 in 5. Think of the old bell curve. You had 1 in 5 stocks lose about 75%. About 1 in 5. Yeah, they lose almost all their value. But about 1 in 5 are really what run up and drive most indexes higher. And then you have about 3 in 5, the bell shape in the middle. They underperform. They make money. They're profitable, but they underperform the overall index.
That's right.
If you had a crystal ball, you would only go buy this 1 in 5 that really go through the roof. But since you don't have a crystal ball, what our goal in an idea like that is, you really want these 4 out of 5 that are going to be positive, and we want to cut off these drastic losses. Is that what you mean by cut off the left tail? And I'm on the screen, so it's actually I should do this in reverse so that.
No, that's exactly right. We want to cut off the big 75% or more drawdowns, right? So the drawdowns are part of investing, and losses are part of investing. It's okay, but what you got to do is you can't have these huge losses. So the idea is, when you have an economic contraction like we're in today, you have to add disciplines to the portfolio that, at least historically, have demonstrated the ability to cut out those major losses. And I'm defining a major loss by anything over, call it 50%, because the law of percentages, it really starts to get difficult once you cross that, call it 40% barrier to the downside. If I lose 50%, the math says I've got to double my money to get back to break even. So when you start,
I'm laughing because I know very few investors that can hang on for that 50%. It just rarely happens. But and this is, please, any clients that are listening, don't call us. We have portfolios built a little bit differently than what Clint's talking about, the negative 50%. But so let's kind of take this. You and I have gotten over into nerd space a little bit because this is the type of conversation you and I like to have. But what can a person do in a recession? Let's use the word because that's what the news is going to use. They're going to use recession. You and I mean contraction or slowdown, but we have an economic recession. What should they start to do now to better themselves?
Yeah. So like we were talking about, going into the slowdown before contraction, that's where you really want to get it right to dial down volatility in the portfolio, reduce risk. So add your defensive playbook, and then you shift up quality in the things you own. Those two things help you get to the point where you can weather a contraction. Now, what is weathering a contraction? Weathering a recession. When you get into the recession, that's when you want to really start looking for your opportunities to take risks, because when we rotate back into a recovery, there's going to be a tremendous amount of opportunities. And so everyone gets scared by the recession. We actually need them. They're healthy. If you think about the story of Joseph, 7 fat years, 7 lean years, right? What do you do during the 7 fat years, or the 7 years of abundance? Is you store wealth, you reserve, and you prepare for the eventuality of that famine period. And when you go into that famine period, that's when you sell what you've gained abundance for, and or have abundance of, right? In order to, number one, survive the famine, but also profit from that famine, as Joseph did. And so I really believe that a recession is the opportunity to, or is a huge opportunity to become focused on what's that next investment I want to make, right? Really get active in taking risks. So it's actually a good thing. And we just become so confused because of this terminology and the doom and gloom behind it. But by the time we know we're in a recession, it is over. It's typically over. Like, we're at the bottom. And so at that point in time, when we actually get this, announced as a recession, it'll probably be a pretty good opportunity to start picking up some bargains and shifting the portfolio, because this is all how you reach your financial goal. Is you've got to be able to play both offense and defense, and you play defense to protect capital. And sometimes that's the focus, is mitigating risk. But then there's other times, and recessions are the best times, in my opinion. There's other times to be focused on taking risk and pursuing return. And if you do those both well over an investment life cycle, then financial goals should be a little easier to hit. And so I'm a big believer in looking at these recessions as opportunity-rich environments. What we were in when we printed $7 trillion and decided to pile that in to the economy, and it caused asset prices to run up to trade at 10 times sales and higher. Like, we've seen valuations that we've never seen before on companies and overall marketplaces because of easy, cheap money. And that presents an environment that is opportunity poor and risk.
Otherwise, and in some of the cases, otherwise good companies that were just too expensive.
Yeah,
I'm not going to start naming them, but a few of them are going through my mind right now that clients have asked about. And I'm like, oh, no, wait, give us a little time and go buy that one. It's a good company.
Yeah,
it was just trading at 1,000 PE. And that's no exaggeration. I mean, there's some out there that are, and again, to your point, this is why economies ebb and flow. We get inflation. The best way to understand inflation, besides going out and pumping some gas right now, is to understand this is like an engine overheating. If you run it wide open all the time, it is going to overheat and it is going to break down. If an engine ebbs and flows like it's built to, it'll run for a lot longer, a lot smoother, and go a lot better. So, Clint, as always, my man, I appreciate you being on. We're going to tackle more of this cycle in our next conversation. We're going to look to the debt cycle, both the short term and the long term. And before our listeners think, gosh, Chris, that's the nerdiest thing I've ever heard, it affects you tremendously. The debt cycle does. And so we want to dive into that really soon. So stick around. We'll be right back. How can recessions affect you? what can you do about it? You know, as Clint said just a second ago, he referenced the story of Joseph in Genesis 41. And let me read a verse from it. 7 years of great abundance are coming throughout the land of Egypt, but 7 years of famine will follow them. Joseph was interpreting Pharaoh's dream, and he had dreamed the 7 fat cows, the 7 skinny cows, and he really just got completely into that subject area in Genesis 41. But we're in no way predicting a depression with this, but you should be prepared for this year. You should recognize that we're in an economic contraction. All the data is already pointing to this, and it's pointing to it right now. And the stock market and the bond market is responding to this contraction. And you mix that with inflation, and you start getting some really wonky terminology out there. But God gives his people instructions going back into the Old Testament of how we can prepare and how we can respond. You see, as I've said this many times, markets ebbs and flow. Economies ebb and flow, businesses ebb and flow, and the economy in your house will ebb and flow. Prepare for an ebb. So you think about it. What are some big projects that maybe you can and should put off? Doesn't mean that you put off all big projects, but what are the bigger ones that maybe you should? You know, how should you modify some of your grocery shopping, some of your traveling, some of your lifestyle? Maybe you should look at your budget and realize you don't have to modify it. Hey, good for you. I'm not saying that everybody does, okay? But you should prepare knowing that the economy is contracting. And just like we just talked about with Clint, there will be a time relatively soon that prices in the markets are going to be depressed, and we should go take advantage of them when that time happens. And so here are 3 things that you can do during a time like this that I want you to pay attention to. Number 1, face the facts. What are the financial facts in your life? How's your income? Is it solid? You know, if you're retired, how much of your income is guaranteed? You know, you think about it, between Social Security, between annuities, how much of that income is guaranteed? You might be seeing the worst part of it now. And in fact, as inflation has peaked and starts to come down, this may become a better economy for you before it becomes better for everybody else. But if you're employed, how solid your job? If you're good, hey, I'm not saying this to get you worried about it, but if you're looking for a job, as of a few weeks ago, there was 2 jobs for every person looking for one. It's not a bad time to find a job. How stable are your expenses? What upcoming expenses do you have this year, the next 6 to 12 months? Your goals are not shot down because of one bad year or one bad month or one bad quarter. So be patient. Now's the time for patience. There will be a time for growth, so be prepared. So number 1, face the facts. Number 2, adjust. Don't be afraid to make changes. While you have a recession mindset today, it won't last forever. When you're playing defense, you have a different mindset than when you're playing offense. If you go hunker down in the storm shelter, don't stay there forever though, okay? What income and expense changes can you and should you make? What are the investment changes that you can or should make? Talk to your advisor. If you manage your own investment money, what investment changes can you and should make? If you're saying, I need to get out of the markets, what is going to get you back into markets? Because I know a lot of people over the years that got out of markets at the bottom of recessions and didn't get back in for years, made disastrous mistakes. Please don't do that. You should have an investment system and stick with your investment system. If you're questioning your investment system, then study some other ones and choose one before you start making changes. But plan to pivot in the future. So number 2 is adjust. Don't be afraid to make changes. Number three, manage your emotions. I have a feeling I'm going to say this all year long, but if you have to turn the TV off, turn the news off, turn the social media feeds off, turn them off. But manage your emotions. Misery loves company, and blood sells. And in all cases, I feel like, at least, it's purely my opinion, but that, our news channels are doing nothing more but selling more and more blood, and our social media feeds have just become where a lot of people, and this is not totally true, I shouldn't accuse everyone of this, but just where it becomes where I go share my misery with the world. But remember this, manage your emotions. You have so much to be thankful for, and you have so many blessings, and there's so much to be managed. If you have an economy in your household to manage, you're blessed. Okay, so manage your emotions. Throughout the Bible and today, God's people live in the same broken world that everybody else does. And so when we study the Bible, we look at finances, we all got to deal with the same mess. We all have the ups and downs in life, but we have excellent guidance in God's word. That's why I turn back to it so many times, but we'll also have excellent guidance when we go look at the economic facts. And so we want to look at the economic facts. That's why we look at contractions and slowdowns, expansions and recoveries. And we want to mix that with wisdom that has just lasted for centuries. So, face the facts in your life, okay? Adjust. Don't be afraid to make changes, and manage your emotions. And remember this, all while you're chasing something good, God's chasing you with something great. Call us if you need us. Shoot us an email. Ask us questions. We're here to help. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.